Chinese markets ended the day sharply higher after China's third quarter GDP beat estimates, though it was the weakest pace since early 2023. Now, this comes as investors await the stimulus measures announced earlier this week by the Chinese finance minister. Joining us now is Olaolu Aganga. She is Mercer's US CIO. It's great to have you back on the show. And that is really where I want to start with you, which is international markets, especially at a time where, as the Fed begins cutting, emerging markets, frontier markets seem to be catching a bigger bid. How would you invest in this? How would you play this?
Now, I've come on the show a few times, and we've been talking about emerging markets, international equities. We've been overweight since the fourth quarter of last year, actually, emerging market equities, Japanese equities. And now that we're seeing a pretty strong bid, stimulus acts out of China lifting up broader emerging markets in September, markets now essentially at all-time highs across the board and lifting. We have recently taken money off the table as a result of that, because given the position that we've had the last few months, we're doing pretty well, and the increased uncertainty that we're starting to see causes just to take a little bit off the table.
Interesting. So where would you be putting that money you take off the table to work then?
I mean, we've been reallocating back. So if we're overweight equities, it meant that we're short in some of the other areas like fixed income. We're reallocating back there. But holistically now, obviously, we had 25 basis point rate cut. We're watching the Fed again. We're expecting another 25. So yields are coming lower. It's one place that at least tactically for now, in the front end, we still have capital there.
Olaolu, great to have you back. So you mentioned the U.S. retirement system is in crisis. What are the implications of that for investors and for stocks, really, where, I mean, the general expectation these days is pensions aren't happening. You need to invest for the future.
Absolutely. Thank you for that. Like, we just came out with our 2024 report, and right now the one place that at least has bipartisan support is retirement. There are some proposals on the table looking at pensions and those types of investments, but roughly speaking, to your point, they're not making any new pension funds. So some of the takeaways there, we know that there are DC plans that are forming. We have different options according to both the risk profiles for the individual clients. We're seeing rising longevity, the higher interest rates, the escalating cost of living, particularly in healthcare, are straining those budgets. So depending on the demographics, if you're younger, you tend to just invest in higher returning assets, even if they are, a little bit more volatile. So equity markets just broadly in general, even though there are highs, that's where we're allocating capital to. And then if you start getting closer to retirement, you want to really start looking at de-risking. But as you indicated there, the retirement study that we recently published is both global, so looking at the U.S., where we do have a C rating ultimately.